Hello and welcome back to a weekly market recap. I'm with Rich.
Hello, everyone.
And I'm Knight. Before we get started, if you can slap a like on this video, subscribe to our YouTube channel. It really helps us out, get in front of new eyeballs, help people understand what's going on with the markets every week. And now, let's get to it. So this past week, we saw the market up 0.03%. So again, a relatively flat week for the market. We're still up 11.31%. But what's surprising is we had a lot of intraday moves this past week. Well, we have three big factors that happened this week. One, huge earnings week for all the large tech companies. We had Tesla, Amazon, Facebook, Microsoft, Google. Honestly, just name a big, large tech company, it had earnings this week. We also finally got a lot of the economic data for the month of April, and we had more of Biden's tax plan or different tax pieces put into the market this week. If we look at how the market did, as we see, we started off the week relatively strong, and then as earnings came in, Tesla was one of the first ones to report, blew out earnings, and yet the stock still ended up falling. We see a jaggedy roof, then all of a sudden hitting sky high numbers on the 29th, and then starts to fall back down. And then we're back up and now back down. And really that's kind of what we saw this whole week, was just this seesaw shark tooth pattern almost of how the market's doing to close. If we look right here, within, about 0.03%. So barely any movement.
Yeah, if you were doing anything during this week, you would have thought that the markets were going to either take off or crash. So it just shows you how things are.
Some of the big things that we saw in Biden's tax plan. So there's some new things that came out on the real estate front. One of the big pieces is getting rid of the 1031 exchange. Now, a 1031 exchange is basically for real estate investors. They can trade in their property without having to pay any taxes, defer the tax on that gain, and transition it to a new property. Now, Biden says that he wants to get rid of all 1031 exchanges, like-kind exchanges, except for ones that are $500,000 or less. Now, Rich, what do you see as a big issue with that?
Well, if you look at real estate in general, there's not a lot of real estate in the United States that has a $500,000 value or less. Now, the part that's very interesting to me about it is that a lot of syndicated 1031 exchanges may work with this because they could have a lot of owners who individual pieces may be less than 500,000, even though a building may be worth many millions. So this may be the exact opposite of what Biden is saying he wants it to do. His comment is he wants to help the small real estate guy, which this is probably a barrier to, but the large syndications probably can sell huge pieces of this to various individuals and make a lot of money on Wall Street. So I think this is exactly the wrong move at the wrong time.
We already have a really difficult housing market for the general public to get in, especially first-time home buyers. Inventory's at an all-time low. People, to even get approved for a mortgage, you have to have incredible credit score. You need to be waiving different contingency, inspection. You have to waive almost everything or do a full cash offer. And now, if this goes through, it would create even more demand for the lower houses. So it would create more demand for these lower value houses, which are the starter homes. In addition to that, if I'm no longer going to get a tax benefit, I'm just not going to sell. I'm just going to keep it cash flowing. I'm going to keep getting those rents on a monthly basis, and I'm not going to sell or exchange it for something else. What does that do? That even lowers the supply even more, and now we have an even lower supply, which leads to higher prices. So I agree that this is a pretty weird proposal.
Basically, this helps people who syndicate real estate deals.
Yeah, it helps the syndicators, the large ones, and probably hurts the individual mom and pop just trying to buy a real estate property for yourself. There were a couple other things that came out on the tax plan. Now, we talked about last week the capital gains, and it seems like the market has almost completely discounted the fact that we could be getting rid of long-term capital gains. And what we've been really seeing is this honing in on the 28% long-term capital gains rate. And that's an interesting point and something that I actually think is feasible. So right now, for certain asset classes, specifically collectibles and gold, it's already taxed at long-term capital gains rate at 28%. So there is already some comfort with that number. So I could definitely see that being put into reality, and anyone making over $1 million could have their long-term capital gains taxed at 28% and no longer 20%.
Yes, what we're seeing is something that's probably going to play in slow pieces because we already have a part of the investment sectors that have dealt with this and know what it's like. So there's probably less of a change to it and less scariness to it because people know how to invest in and around it.
And we have seen this before. So we've seen before when the capital gains rate jumped up from 15 to 20%. Now, we did see a market sell-off when that happened back in 2013, I believe was the year. And we did see a sell-off, but it was also short-lived and it was mostly people on the margin. Now, if we see a jump from 20 to 28%, I feel like I could probably see a similar sell-off, but a shorter sell-off. However, if we jumped all the way from 20 to 43%, I think that would be, it's a completely different ball game. At that point, I think we'd see a massive sell-off from people trying to lock in their gains and then pandemonium. Now, again, the market is definitely not pricing in for that. It doesn't believe that would happen. And I agree. But one thing that I think is important is with the incredible earnings that we had this week, we still saw a teeter-totter. Some companies really took off and some really got punished. What does that tell me? The market right now is almost pricing in for perfection. So if your company isn't perfect or hitting those numbers consistently, I think it could drop off.
In addition, what's the guidance for the next couple of quarters? If companies have done really well and they're priced really well, but they view everything and they say, looking forward, we think we may have some problems, we're also going to see sell-off. And that's sort of what we're beginning to look at. Because remember, everybody in the stock market is looking at what's going to happen tomorrow. It's forward-looking, not real-looking.
Now, the last piece that we saw this past week was on Friday, the core inflation data actually came in at 0.4% month over month. And that's a little bit higher than what was expected, 0.3. But one of the numbers that I really want to point to is that was core inflation. But if you add back in food and energy to get inflation, it was in 2.32 to 2.5%. And again, we're still looking at the base effect. This is all what was expected for the month of March, April, May to really have that base effect. But it is interesting to at least notice, see, and think about going forward. Are we going to continue seeing this rise in inflation? If this is just the base effect, I think we're okay. But if we are annualizing that 0.4%, we're at 4.8, and that's huge. That would be massive. So if we continue seeing something like this, then it would be potential to start to worry. Now, it was 0.4 for the month of March. It was 0.1 for the month of February. So it just shows where we are, but it's something to keep an eye on. The market's not really reacting to it, but the market also for the past 2-3 weeks has been fighting for direction.
Absolutely. And part on the inflation, we also have to remember that due to the pandemic, there was a shutdown in the country. We are witnessing a lot of bottlenecks and higher prices on various items due to those bottlenecks. And also there was a lot of damage in Texas from freezes that have rippling effects. And it's probably going to be till the fall until a lot of that ripple effect and backlogs are worked out of the system. So some of this inflationary pressures is to be expected.
Again, higher personal income, more spending, higher inflation. All these pieces are going together, which is the mark of a healthy economy. But is it going to run too fast, too far? And that's where we are looking at it, being attuned to it. Well, as always, we appreciate you guys taking the time to listen. We're here to support you. Your money's here to support you. See you again next week.